please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Welcome back. Well, a quick look at the Asian markets because they are holding up in the green. The Hang Seng is up around 40 points, up around 0.15%, while the Shanghai was also in the green at the last time I checked. Kospi as well as Nikkei trading in the green. SGX Nifty for starters suggesting an uptick of around 26 points. Remember, the US markets ended lower yesterday because of the trade war concerns, but that is something that the Asian markets already factored and reacted to yesterday because all the Asian markets yesterday were down about anywhere between 1 to 2%, with Shanghai being the key underperformer, down about 1.8%. But back home on the Lal Street, the markets failed to hold on to gains, with the benchmark indices ending flat. The Nifty closed below the 10,950 mark, with financials as well as autos dragging, while the Sensex failed to sustain an all-time intraday closing high. The mid-caps underperformed, ending with cuts of about 91 points, while the Nifty Bank ended around 30 points in the red. But that was about yesterday. Let's see how the Indian markets will react today, because yesterday they were quite a bit of outperformer relative to how the global space was doing. Ekta joins us to tell us how the market cues are stacked up for today. Ekta, good morning. Over to you.
Thanks, Anisha, for that. Well, like you mentioned yesterday, it was actually quite an interesting day of trade. The Nifty did close below 10,950. The broader markets underperformed, and the market breadth was really in the favor of the declining trend. But what was interesting was that the FIIs net bought over 600 odd crores in yesterday's trading session, and the gross figures were anywhere between around 4,900 odd crores to 4,300 odd crores. Now, why is this important is because we did see the FII net sell contract to 21 odd crores just in the previous trading session, which is now, turned into a net buy figure. So it's important to see whether the trend has turned for the FIIs or not, or whether this is just a flash in the pan that took place. Remember that the TCS delivery buying, and this is according to Mangalam statistics, were around 1,900 crores in yesterday's trade. So maybe, just maybe, it could have just been one stock specific kind of flash in the pan FII interest which came through, considering the kind of volatility that we're seeing when it comes to news on trade tariffs. So for today, the biggest cue, I think, according to me, would definitely be what has happened with Brent crude overnight. So Brent crude has fallen around 5 odd %. Libya, it seems, has resolved supply concerns, and the fact that there are certain sentiment positives which are any which way placed for our market. The Nifty and the Sensex are at all-time highs. We've seen that FII net buy figure come through. We have a couple of stocks which are at all-time highs from the Nifty space, giving you a sense in terms of the narrowness of the market as well. TCS, HUL, Asian Paints, etc. If you're talking about the US markets, US was down. We have the trade concerns which are continuing in terms of concerns. Asia is mixed largely today, and if you're talking about the results that we need to work with today, it's Karnataka Bank, Cient and Talwalkar's Lifestyle. We also have the IIP for May as well as CPI for June, which is expected later today. So overall, maybe we would be resilient.
All right, maybe we would be resilient. What are the stocks you're watching out for, Ekta? You did allude to a few of them.
Well, yes, we have HCL Tech, which is going to meet with regards to buyback details. So that stock will be in focus. Ashapura Intimate Fashion, which will be in focus on account of a new store which they'll be opening. Quality, which has decided to close business operations with regards to dairy products in Dubai. Max Ventures and Max India, where the company has clarified with regards to SEBI rejecting Max Group family's request for open offer exemption. Sun Pharma, their wholly owned subsidiary DUSA, has filed a lawsuit against Biofrontera with regards to patent infringement. RIIL will be in focus on account of numbers. The profit was around 2 crores versus 1.8 crores, so just about a flat performance. Bank of Baroda, reports of the Bank of Baroda MD being considered with regards to for the role of Axis Bank MD is speculative as per the company. Coffee Day, subsidiary of the company, has entered into a collaboration with Uber Eats, so that'll be interesting to see how the stock reacts. Manappuram Finance, there's been an QNAG, which is an FPI, has bought an additional 3% stake in the company. An idea, approval of the DOT with regards to merger is conditional and not the final approval as per the company.
Okay, thank you, Ekta, for getting us all those cues as well as the stocks to watch out for in trade today. But it is time for a short break on the show. Up next, Chief Economic Advisor Arvind Subramaniam calls for major reforms in the economy.
Welcome back. This is Power Breakfast. You're watching on CNBC TV18. Let's get some power talk in. Then, India's public sector decision-making is paralyzed. I quote a candid assertion that's coming in from the outgoing Chief Economic Advisor, Arvind Subramanian. He was speaking at an event in Delhi yesterday, blaming what he called, again I quote, stigmatized capitalism. The Chief Economic Advisor said, again I quote, a pall of gloom hangs over public sector decision-making. Subramanian went on to lament the lack of reforms, especially in public sector banks and their recruitment process. This, he believes, has diminished the risk-taking capacity at these institutions. Subramanian also went on to say that public sector lending over the last 10 years has become toxic.
I think that what stigmatized capitalism is doing in India is that you will get more role for the private sector in greenfield and in terms of entry. But greater private sector role for in kind of taking over existing public sector assets is going to confront the stigmatized capitalism problem, because the political authorities will always, and public sector bureaucrats will always come under this cloud of, you sold this asset, did you do it in some kind of sweetheart deal? And I think we've spoken about the 4C, the wall of the 4C problem that hangs over. So public sector decision making has been completely paralyzed by this, and something similar. See, when you said, I think it's not quite right to say that, nothing has come on, because Air India was on the block for a very long time. But I think that, again, a version of stigmatized capitalism, I think, has kind of taken over. And I think that, could these decisions be second-guessed in the future is something that still creates. Now, the interesting thing about this IBC, I think I want to, again, do a mea culpa by way of explaining something, is that, see, I was early on in favor of a bad bank, right? But then the IBC happened, and I've come to realize and accept and acknowledge that the IBC was the more realistic way forward because of stigmatized capitalism, and in the following sense, that when a bad bank would have given the lead role to the executive and the political process, and they've been in the front line in terms of these negotiating negotiating. What has happened with, so I think, okay, so I think a consequence of stigmatized capitalism is that more and more decisions will be taken by the judiciary, because they are seen as the most kind of, legitimate and fair kind of people to take this decision. So if you've stigmatized capitalism and you're not sure either about the private sector or about public sector regulating the private sector and all of this, I think you're going to see more and more of this quasi-judicial or really explicitly judicial way of disposing public sector assets. We have to have more private sector participation, but I think for three new reasons. The old reason is, politicians interfere with resources. That's still true, but that also happens to private banks in India. So I think we have to be thinking. But I think there are three new reasons why I think we should have more private sector ownership. One, I think this whole 4C problem, the pall hanging over good decision making, I think you get out of the public sector, you have that one. Second, I think that this is kind of the new point, which is that the public sector is just enormously handicapped in terms of their ability to recruit people.
The tenure,
all
the management.
So public sector banks really don't have very good risk assessment capability. I mean, and to be fair to them, it's not because they are bad or inefficient. They just can't recruit. So I don't know whether I mentioned this last time. If I'm repeating myself, forgive me, that in my first year here, Raghu invited me. He was governor. He invited me to come and give the convocation at NIBM. Now, NIBM is an institute, training institute for bankers, run by the RBI. So after the convocation, Raghu and I were chatting, and Raghu said the irony is we pour resources into this. No public sector bank can come and recruit at NIBM, because public sector banks can only recruit through the bank exam process. So this is kind of a ridiculous situation that we're in, that, you know, we put in public money and we can't do this. And so those restrictions that happen, I think, are the second reason. The third reason, which again is that we have found in the last 10 years with this, that public sector lending to private sector lending is so toxic. Getting out of it is so difficult that we don't want to repeat this going forward. So I think that therefore, and then there's the other reason that, you know, Governor, you know, Urjit Patel says, is that when you have public sector ownership, it complicates, you know, the regulator regulating public sector banks.
Okay, those are very candid words coming in from Arvind Subramaniam, talking about the paralysis in the public sector regarding decision making. Do watch out for that conversation. We will be playing out bits of that through the day. But it is time now for a short break. Up next, Telecom Commission approves the... Welcome back. Well, CNBC TV18 news break confirmed the Telecom Commission has approved the National Digital Communications Policy 2018. Now, the new policy framework focuses on the digital transformation of the telecom sector, aiming to provide broadband connectivity to every citizen. Ashwat Kumar filed a report to tell us the details of the policy.
Well, indeed, the National Telecom Policy, envisaged as a game changer for the telecom sector, has today been approved by the Telecom Commission. Now, why is it significant? What are the features of the NTP? Well, one of the reasons it's significant is because it is the NTP that envisages, that seeks investments of nearly $100 billion over the next 4 years. It also talks about ensuring adequate availability of spectrum and realistic pricing of spectrum. That has been a constant complaint of various telecom players, that the pricing is too high. The NTP also talks about rationalization of various levies. Speaking of the stress in the sector, that has also been a demand by the sector, that there should be a rationalization of levies. It also seeks indigenization of R&D and manufacturing, recognition of the sector with an infrastructure badge. That has also been a long-standing demand of the telecom sector, as well as smoother M&A. Now, while we speak of smoother M&A, what's interesting is that the DoT secretary in the same breath also pointed out that she confirmed, in fact, that there has in fact been a demand slapped on Vodafone and Idea, that the ball is squarely in their courts to decide whether they want to comply, whether they want to pay up or move the courts. That's completely in their court. But she also said that consolidation is in the interest of the sector. So a slight divergence there, but nonetheless, the Telecom Commission, having approved these recommendations, they will now fall before the cabinet for their final approval. So on that note, at least a step forward as far as the NTP is concerned. But again, the DoT secretary confirming as to the status of the demand and that the ball is in the court of Vodafone and Idea. Back to you.
All right. With that, let's move on to a CNBC TV18 exclusive. This one from the policy space. Sources tell us that the Niti Aayog has suggested that the centre should replace the LPG subsidy with fuel-agnostic cooking subsidy. Anshu Sharma filed this report earlier.
That's right. Niti Aayog has written a letter to Oil Ministry seeking replacement of LPG subsidy to fuel-agnostic cooking subsidy to consumers. Right now, government gives subsidy on usage of LPG for consumers which earn less than 10 lakh per annum. Niti Aayog is batting for cleaner and cheaper fuel like PNG or piped natural gas and biofuel. It says that PNG should be used in tier 2, tier 3 cities, and biofuel should be used in villages. It also says that subsidy on LPG should be replaced to cooking fuel subsidy, which should be agnostic to fuel, and consumers should have a choice of using PNG or biofuel, and that subsidy should be transferred like it is transferred in LPG via direct benefit transfer. It also says that Pradhan Mantri Ujjwala Yojana has brought in a lot of consumers because of subsidy, and government has added over 4.6 crore consumers under Ujjwala program, where government has given over 12,000 crore capital subsidy to bring in new consumers for usage of LPG. So we'll have to see how Oil Ministry responds to that.
Okay, moving on and talking about some stocks that will be in focus today. HCL would be on our radar as the board will consider a buyback later today. Rima joins in with more details on that. Rima, good morning. Last year, the company announced a buyback of around 3,500 odd crores. Is that the range the street is expecting this time as well?
Hi, Anisha. Good morning. Yes, absolutely. So close to about 3,500 crore, or what they did last year, is what the market is expecting this time as well in terms of HCL Technologies buyback. If they do a 10% buyback, which means just purely going by the board approval. 10% of its net worth is around 3,700 crore rupees, or 2.7% of the outstanding equity. A 25% buyback, which is 25% of the net worth, which they can do if they take a shareholder approval, that puts the buyback amount up to 9,200 crore, or 6.8% of the outstanding equity. The company has sufficient cash, so the cash is close to $1.5 billion, or a little more than 10,000 crore rupees. The promoter holding stands at 60%, and like last year, they are expected to participate. As you said, last year the company did a 3,500 crore buyback, which was roughly about 2.5% of the outstanding equity, and about a 17% premium to the prevailing price at that point, which was about 1,000 rupees per share. So let's see what HCL Technology does this time. It will be the second IT company after TCS to do the buyback.
Absolutely, but Rima, will Cyient be the second IT company after TCS to also deliver on their numbers? The results are today. What is the street expecting?
Well, the expectations are quite muted, Mangalam, for Cyient. So just a quick run through, the stock has done well. It's rallied 27% in 2018, so it's moved along with the rest of the IT pack. But its valuations are poorer than that of its mid-cap IT peers. So it's trading at F520 PE of close to about 15.5 to 16 times. And the key reason for that being is the free cash flow to EBITDA is weaker for Cyient as compared to its peers. Quick run through of the numbers, as you can see on your screen. Dollar revenue is seen down by 1.3% on a quarter-on-quarter basis. We expect the margins to fall by more than 150 basis points to come in at 10.5%, and that will drive an 8% decline in the profitability according to our poll. So profit could be closer to about 109 crore. The reason is why we're expecting a muted set of numbers is Q4 was exceedingly strong for the company. So in Q4, the dollar revenue growth was close to about 8.3%. So on account of a high base, the numbers will look weaker. But not just that, even design-led manufacturing, which is one of the key verticals for the company, that had an 80% growth in the prior quarter. And on account of weak seasonality, this quarter it will decline by close to about 30%. Even services, so you break up their business into services as well as design-led manufacturing. So design-led manufacturing could see a 30% drop quarter on quarter in their revenues. But even for services, like, it will be a weakish quarter, about a 2% growth. The margins will be weaker, down quarter on quarter on account of a wage hike, as well as normalization of the high margins in their design-led manufacturing. We expect the company to maintain its full-year guidance, which is a double-digit growth for services, design-led manufacturing to grow at 35% with flat margins. Back to you.
Thank you, Rima, for getting us those details. So muted quarter is what is expected from Cyient this time around. But let's move on and talk about the commentary coming in from Jaguar Land Rover India. Now, they say that we have no plans of stopping assembly operations in India. That's the word coming in from the President and Managing Director of Jaguar Land Rover India, Rohit Suri. Remember, in March this year, the Jaguar Land Rover had said that it would reconsider its assembly operations in India post the customs duty hike from 10% earlier to 15% in the budget 2018. Listen into this conversation that Jude San actually had with Rohit Suri.
Your sales report is out, 66% growth in terms of sales itself. Happy considering it was projected to be a difficult year, especially after the customs duty hike on CKD kits?
We are extremely happy about it, and we are really thankful to our customers. We are very, 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 humbled by the fact that we see a growing patronage for our cars. But I think this has happened mainly on the strength of the products and the brands. Most of our products, which includes the Jaguar XE, the Jaguar XF, the Jaguar F-Pace, the Discovery Sport, and the Range Rover Evoque, are doing extremely well. So individually, these products are doing well, and that is what has helped us to achieve this kind of growth.
Very interestingly, a few months ago, you said you were considering suspension or stoppage of local assembly plans, especially in the hike of the customs duty surrounding CKD kits. Has a decision been taken yet surrounding that, and if yes, when will you come around to that?
So we have clearly stated that we are very concerned with the high taxation which exists in India, not only customs duty but also on account of GST, because we feel that this is constraining and constricting the market, the overall market. Yeah. So the overall market in India is just about, for these cars, in the range of about 41 to 45,000 odd units, which is just a percentage of the overall passenger car market, which is almost about 3 million. Okay. So what these high taxation is doing is it is not allowing these segments to grow. And therefore, that is of concern to us. I think we are not stopped assembly of our operations at all. We are continuously, you can say, evaluating the situation.